This is a daily chart for gold. Remember the ultimate low in the Dow Jones Industrial Average. Remember that was March 6th. Well, I drew a vertical line March 6th. Now, how does the market treat gold? Remember our matrix from top to bottom. Topping the most conservative financial instruments out there, gold, I would say, close to number one. And at the bottom of our matrix, we would write down our technology stocks and our biotech stocks and really, really speculative, dangerous financial instruments. Well, as the stock market tends to go up, well, let's take it a different way. As the stock market goes down, after companies, Lehman Brothers goes out of business and Citigroup files for Chapter 11, whatever it may be, General Motors, I should say, files for Chapter 11, Citigroup accepts TARP funds, whatever it may be, we see the stock market go down. We run out of stocks. We don't walk, we run out of stocks. We buy low-yielding currencies in a hope to preserve our capital. Well, low-yielding currencies include the dollar and the yen. But even more low-yielding than the dollar or the yen, what's the safest financial instrument out there? Gold. Gold has really acted as a safe haven of currency, as a hedge towards a falling dollar. The reason being is myself, for example, I'm a U.S. consumer. I make U.S. dollars. My U.S. dollars, well, I use them mostly in the U.S., but the fact of the matter is if I want to use my U.S. dollars outside the U.S., in the Eurozone or in the U.K., my falling dollar has really made it very, very difficult to take any kind of European vacation anytime soon. It's made it very difficult to buy the same equivalent amount of products and services in Australia and New Zealand. Now, me in particular, it doesn't really affect me. However, think of these multinational corporations. Well, these multinational corporations say, wow, Microsoft, U.S. corporation, they have offices all over the world. We have to pay our European employees and our Australian, consumers, or producers, I should say, we have to pay them in their local currency. We have to use our U.S. dollars to buy their local currency. It's going to take a lot more U.S. dollars to buy the same amount of euros to pay those employees. Well, Microsoft has more money than they know what to do with. But nevertheless, it's a huge concern for them. So in order to protect and hold on to the value of the U.S. dollars, as my U.S. dollar falls against the euro, I buy something else that hopefully will maintain pace with the euro, maybe even outperform it. So whatever capital I lost in the dollar, I'll make back in gold. And that is why gold has done so well. But something doesn't make sense. Remember, we took a look at the Dow Jones Industrial Average charts. The Dow, from March until December, went almost straight up. Well, if the Dow went almost straight up, then we should expect gold to go down. After all, if the Dow goes up, we would expect gold to go down. With stocks are doing better, no reason to hold gold. We don't need to hedge ourselves. But remember, the dollar was still falling. Gold acts as a hedge towards the dollar, a falling dollar. It acts as a hedge towards inflationary pressures. Inflationary pressures because the Fed has printed so much more money, trillions and trillions of dollars in the stimulus programs. What has happened is there's more money out there. It's like the U.S. government did a 10-for-1 stock split. Now we have that many more U.S. dollars out there. However, I still need the same amount of U.S. dollars to buy a hamburger or to buy a flat-screen TV. Therefore, each U.S. dollar that I actually hold is worth a little bit less. So we see different rallies occur at different times. Not always will gold go down when the Dow goes up. Not always will it go up when the Dow goes up. There are different fundamental forces which constantly push and pull at the foreign exchange market and our global economy that dictates these trends. But if we can make the bridge from one market to another, I think we're going to have a huge advantage. Take a look at gold. Take a look at the all-time highs. All-time highs on the futures, 1226. That was on December 3rd. Remember December 3rd. Now remember, what currency tends to benefit from high gold prices? Well, if you say the Swiss franc, I think you're right, because a huge amount of gold deposits are held in the Swiss franc. But outside the Swiss franc, my first inclination would be to mention the Australian dollar. So again, the highest highs we saw were December 3rd. Take a look at the Aussie dollar charts. Let's zoom in. Should see Aussie dollar chart in front of you. December 3rd. Well, the December 3rd line is the fourth line, if you can see this. It is just after the December 2nd meeting. Reserve Bank of Australia raised rates 3 times, and about 2 days after the last interest rate hike, gold hit an all-time high, 1226. Not inflation adjusted, but as far as on a dollar-to-dollar basis, gold hit an all-time high, December 3rd. So when gold starts to pull back, the Aussie dollar had actually hit a slightly higher high prior to that. By the way, this is known as a head and shoulders pattern, and it's considered a very, very bearish pattern. So we see markets hit highs and lows at significant periods of time. Now, with that said, and I know I'm just about out of time, but I want to mention one last thing, and hopefully this is some information you can use moving forward. Take a look at the Aussie dollar daily chart. The highest highs we've seen in a long time are 94.04. I say November 16th, 94.04. Above 94.04, how far back do we have to go to see the Aussie dollar hit higher highs? We have to go back to August of 2008. Remember the euro dollar. The euro dollar, we draw a line at the highest highs we've seen, 150.90, December 4th, 2009. If we cross back above those 151 levels, we have to go all the way back to August 2008. Then we take a look at, we saw the Aussie dollar. We saw, I want to show you one other currency pair. Take a look at something that has been a lot stronger. It was the dollar crosses, but the yen crosses have really been active lately. Take a look at the Aussie yen. The highest high, 85.31 on October 23rd of this 2009, I should say. If we pass above that, we have to go back to October 2008. Take a look at the Dow Jones Industrial Average, 10,487 in the futures right now. If we break a clean break, I know we've been trading up there. If we see a nice big move, a breakout above this consolidation pattern, we would then be at levels we haven't seen since September, October 2008. Take a look at the gold market as well. Well, gold has pulled back quite a bit, so let's ignore gold. Take a look at crude oil though, 81.44. The highest highs we've seen in a while are the 81.94 highs in the futures, October 21st of last year, and above $82 per barrel of light sweet crude oil, we have to go back to October of 2008. So we mentioned the Aussie yen, the Aussie dollar, maybe to a lesser extent the euro dollar. Take a look at the Kiwi yen, the CAD yen. Take a look at crude oil, and take a look at the Dow Jones Industrial Average. All of those markets that I've mentioned are at or very, very close to more than 1 year highs. Reason being it's important, my theory is that if we're getting the next big move, and we've been consolidating for a while, the January effect usually puts some momentum and volatility back into the market, we need to try to find the next big move. Will the next big move be Dow 10,500 and up, or will it be Dow 10,300 and down? What will be the next big move? My theory is that these markets will confirm each other. If the Dow breaks a new high, you'll want to see crude oil break to new highs confirmation. We want to see Aussie yen at a new high. We want to see at least some of these currency pairs break to new highs. Pay attention to which currency pairs break those new highs first. My guess, I would say the Aussie yen, maybe the CAD yen would be the first currency pairs to break to new 1 year highs, maybe the Aussie dollar as well, but probably yen cross if I had to guess. Those currency pairs, or whatever currency pair breaks out to new high first, they should break out to new highs. If the Dow breaks to a new high and nothing else does, there's some disconnect, and chances are that move will not continue.